Welcome to the Net Wealth Nest podcast, the show that helps everyday people build real financial stability, starting from wherever you are. Whether you're working your way out of debt or just starting to save, we're here to help you grow your net wealth to your first big wealth milestone. Each episode, we break down the mindset shifts, practical tools, and real-life actions that can transform your financial future. Thanks for tuning in. Now let's get to work building your net wealth nest. Welcome to Net Wealth Nest Podcast. I'm your host, Jim LeBeff, and thanks for joining us for another episode as we help you build financial stability and grow your net wealth. It is mid-2025 as we're recording this, and what I'm starting to hear and questions that are coming up are around buying a house. In 2023, we saw interest rates spike super high and the housing market shrink dramatically for people who were selling, people who were buying, all that. And what we're starting to see is those interest rates have seemed to stabilize somewhere between 6 and 6.5%, at least in mid-2025. And we're starting to see more people put up their house for sale. In fact, we're starting to see more sellers on the market than we have buyers that are interested in buying homes, which means it could be time to buy. And those who are interested are starting to ask questions on, what do I need to do to get ready to buy a house? So this is a little bit of a three-part series that we're going to do over the next couple of weeks on how to buy. And how it's going to be broken out is we're going to go into how you start prepping for being able to buy a house, then the actual act of looking for a house and what that looks like for offers, agents, all those things. And then the last piece, we're going to talk about closing that house and actually completing the purchase. So today, let's start off with how should I prep to buy a home in today's market? And the first piece is getting your mindset right and setting a timeline. You should look to set a timeline that is applicable for you to have a great down payment on your home, and then as well as give you enough time to maybe impact your credit score in a positive way if you need to move your credit up, or to make sure that you get all your ducks in a row with having all of your paperwork together and all those types of things. Many people will set a time frame of 0 to 6 months, 6 to 12 months, or 12 to 24 months. The other thing we recommend is if you are with your spouse, you should obviously talk to your spouse and set that timeline together. But if you're doing it yourself, also having like an accountability buddy or somebody else in your family or friends that knows, hey, I'm interested in buying a house and this is the time frame I'm doing. Can you help me stay on course and be my, a little bit of a accountability coach to keep me moving in the right direction so that I can actually secure this dream that I have? There's a couple of rules as you go through this time frame as well. You should not be adding new debt to yourself. If you can avoid new debt, and you should actually be paying some down if you have some, that will help you as you get to the loan process and make you a better qualified borrower to the bank. You shouldn't miss any payments. And of course, if you can avoid it, you shouldn't be changing jobs. Banks want to see stability. And so that's why not having any new debt, not missing any payments, and not changing your job looks great to a bank when you go to apply for your loan. So let's talk about affordability. What we typically recommend is that your housing payment is not more than 25% of your monthly pay. So for example, if you make $6,000 a month before taxes, 25% of that, your payment should be around $1,500 or less for your home loan. That keeps you in a good position where you're not overstretching and what they call becoming house poor, where you buy this house and all your money is going into paying that monthly payment. You still need to live your life and have the other things that you're doing, whether it be your investments, your savings, your repairs, which we'll talk about in the future, all those things. So the 25% is where we want to be from that standpoint. The second thing to keep in mind is what your debt to income ratio is. And that's more for the bank to understand, what do you have for payments currently and will you be able to afford this? A bank typically wants to see 45 to 50% or less debt to income ratio to understand that you can afford this home. And the closer to 30 or less, even better. And all that means is, what credit card bills do you have? What other loans, what other obligations are you being asked to pay for? And what is that percentage of the income that you're making already? And they're going to take that into account with what you can afford for a house. So for example, let's say, again, you make $6,000 and you have $1,500 of recurring payments, maybe car loans and credit cards, that's going to be 25% right there. That's going to be okay, because then they're going to be like, okay, that plus the house, you're at 50%. You're okay. You're in a good spot. If you have more than that, you should be working to pay down that debt, maybe while at the same time saving for a house and down payment to get that debt to income ratio under. That will give you, along with hopefully a good credit score, the best rates and the best opportunity to secure a really solid loan from a bank. So once you understand where you are at, you can do this with different calculators online. I will link in the notes a calculator that I've used that's really straightforward that will allow you to input the price of the house, how much the down payment will be, what taxes would be estimated at, and what your insurance would be estimated at. You can input all those and it will spit out what your monthly payment will be. Once you figure out what that is, you can start to play with, okay, how much should I put down and what does that help me from an affordability? Like, what can I afford? And there are different things you can do for down payments. You can do an FHA loan, which is very common, especially for first-time homeowners, of 3.5%. If you're a veteran or they have USDA loans, you can put down 0% and they will loan all of it. What you need to understand with these loans is if you put down less than 20% of whatever the cost of the house is, you will pay a little bit of an additional fee monthly in your mortgage. That's called PMI. It's private mortgage insurance. And that is insurance that covers the bank. If you default or can't pay for the loan, they have insurance. So if they would foreclose on the house from you, they are not sitting on something that they are going to sell at a loss. They have insurance that you are paying for them to cover them in that situation. And so if you can get to 20% down payment on your home, that's the best situation. A, it lowers your monthly payment. And then B, it also eliminates the need to pay a little bit extra for private mortgage insurance or PMI. That's not always the case when you're buying a home. That can be difficult to save up for. We'll just look at a home in the Iowa metro area like Cedar Rapids as an example, a Midwest town. So the homes are still relatively well priced here, but $200,000 to $240,000 will get you into a basic 3-bedroom, 1 to 2 bath house with anywhere between 1,200 and 1,500 square feet. Pretty good, like first home for sure, but overall generally nice building, usually built somewhere in the 1950s to the 1970s. That's going to run somewhere between $200,000 and $240,000. And so a 20% down payment could be $40,000 to put that down. That could be a lot of cash to try to stack up, depending on what your timeline is. And so that's why they offer other options. Just keep in mind, that is really going to dictate what your monthly payment will be. The more you put down, the less your monthly payment will be, as simple as that. With that, you want to know how much cash is needed. So you'll take that down payment, whatever you think you can afford or whatever you're going to build up to, but there's also closing costs. And those are usually 2 to 4% of what the price of the house is. A good way to estimate that. So if you are buying, let's just say, a $240,000 house, you're going to spend about, we'll use 3%, maybe another $7,200 in closing cost fees. They're going to be fees for your closing costs from the bank. They're going to be fees from inspections, like those types of things that you'll have to pay. And so that could be another several $1,000s that you want to take into account and be ready to save for. And then the other thing to keep in mind too is you should also have a good emergency fund that you're not destroying when you buy a house. So for example, when you buy a house, if your furnace goes out, that could be $4,000 that would need to be repaired, or air conditioning, depending on where you live. Those costs can jump up on you really quickly. And so you want to make sure that you have enough of a emergency account saved up that you're not going to touch for your down payment or your closing costs. You're going to keep that for repairs. You could typically anticipate 1 to 2% of the home's value every year that you're going to spend in some sort of maintenance. And that could be something as simple as repairing some boards on the porch or the deck on the back, which might only cost a couple $100, all the way up to as expensive as, like I just mentioned, an air conditioner or a furnace going out could be $4,000 for each one of those items. There are really expensive items like a roof that could need to be replaced that could be $15,000. Again, you should be saving that and continuing to put that into your emergency fund to protect you from when those things are going to happen. So the next piece you want to think about in preparing is your credit worthiness. Depending on what your down payment will be, if you're going to start with an FHA loan where you're going to put down only maybe 3.5%, you're going to need somewhere between 580 and 600 credit score to be able to qualify for that. The higher credit score usually improves where you can get like a conventional loan, which usually gets you a little bit better interest rates. And if you get above a 680 or 700, you're going to not only improve your interest rate on your loan, but if you are putting less than 20% down, and that'll actually give you better PMI, or you'll pay less for that private mortgage insurance with a higher credit score. This will help you secure the best type of loan for you with the best rates. So the goal is when you've decided your timeline, how else are you building your credit up if it is lower than what you want it to be? The easiest way to do that is to pay off debt and make all your payments on time. The more you do that, the more your credit score will go up, and you'd be amazed that over a year or even 2 years, if you have a longer time frame, how much you can actually improve your credit score by just making payments on time and opening up the gap between how much you are bringing in from income and how much is going out to that revolving debt is a huge win and a huge boost to your credit score. And so once you get through that, the last thing to start looking at in your prep phase is lender shopping and a pre-approval. What I recommend is you should always be shopping multiple banks to get the best product. And what I mean by product is best loan. That's what banks will call it. They offer multiple different products, and really they're just different styles of loans that they offer to different individuals based on all the things we've talked about. Things like how much you make, what your credit score is, what your debt to income ratio is, like all those things they're going to take into account on that. And so you should be shopping around. The cool part is many people think every time they go to the bank and the bank pulls their credit to look at it, they're getting dinged and their credit goes down. What has changed is as long as you do it within a 2-week window or 14-day window, you can compare all that. It will not ding your credit every time you do it. So if you want to go through 3, 4, 5 banks to do that, as long as you do it inside of 2 weeks, it's not a big deal. And then you can compare and contrast, and you can actually get approval letters from all of them in that circumstance if you want. I recommend you get at least 2 pre-approval letters from the bank. The one would be a max pre-approval letter, so like the maximum that you would be able to afford. And then the other one would be a pre-approval letter at your offer price. Most sellers, when you put in an offer, they are going to want to see that pre-approval letter. And so having a pre-approval letter for your offers, you must have. The other thing you want to do is you want to get a total cost, and most banks will do this over 5 and 30 years and not just the rate. The 5 is that break-even point where you want to make sure that after 5 years, if you would need to sell, you would be able to sell it at a price where you would be able to recoup your money so you don't have to put money in to get rid of the house if you need to move or you change jobs or any of those types of things. The 30-year will just let you know that over that 30 years, how much interest you'll pay. It's a lot. It's usually just as much as the house costs itself, if not sometimes more, especially with where interest rates are today. Just know that that's okay. Like everybody goes through that experience of that gut check of interest. In the future, you can look at how to pay down your house faster as necessary. Other things you should ask when you're going through the loan process is, are there any type of first-time buyer or down payment assistance programs that fit me? Those have caveats. Like, for example, if you get a down payment grant where the city sometimes will offer that, where they're giving money to those individuals, maybe a couple $1,000s for free. They also lock you in where you can't refinance or you can't move out. So read the fine details when you ask those questions, but it's always good to find out what all the options are. You can also buy down your rate, but that will cost you additional money up front. So that all that money we talked about earlier where you have to have in advance for like closing costs, you can buy down and get a cheaper rate, but you'll need money to do that. And then what's your rate lock policy and timeline? So for example, you don't want to get a pre-approval letter if you are more than probably 90 days out of wanting to buy that house. And most banks will usually do a 30 or 60-day rate lock. But you want to make sure that as you're getting those pre-approvals, you should be inside their window of when you can buy. And usually that's 90 days or less. So if you are deciding today you have a 2-year timeline, this lending part where you're going to get these pre-approval letters should be the absolute last thing as close to that 2-year window where you're ready to pull the trigger and actually buy a house. When you're looking for a bank, I typically recommend you start local. Look for localized credit unions, small regional banks. I typically recommend that you stay away from big players like the Banks of America and the Wells Fargo of the world. And the reason being is most people think that they're going to get the best rate with the big bank because they do all these loans, and that's usually not the case. Usually you actually get better rates and better, again, products or better loans from your local or regional banks because they want to lend inside the community. They want to build the community up. That's who they serve. That's what they're about. And so typically you will get some better offers from those individuals. Not always, but you want to get multiple offers from them and maybe one or two big banks that you can compare and contrast and see what is going to be the best deal on the terms of the loan, the interest rate, all of those. So to recap that, it's about basically understanding your timeline and how much money you'll need to put away to save, and then working on your debt and your credit score during that time frame, not taking out any new loans, not changing jobs if you don't have to, making sure you're making all your payments. Again, building that credit score as high as absolutely possible to get the best rate, the best loan product that you can get, and then doing your due diligence on finding multiple offers with banks and figuring out like who has the best rates, who has the best loans in your area that are going to work for you, and what are all the different offers that they might have. Once you do all that, then you will be ready to move on to step 2, which we're going to cover next week. And that's actually finding an agent, looking at homes, doing all those types of things. More to come there, but start here, start with your timeline, and then build up your credit score and destroy your debt. Thanks again for joining today for our podcast. We really appreciate you coming and learning more. We want to help you build financial stability in your life and grow your net wealth. If this is helpful, please can subscribe our podcast on either YouTube or whatever you listen to podcasts on. Come visit our website. We also offer different opportunities there for accountability and coaching. Again, my name's Jim. Thanks for joining today. Bye, everybody. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.